Hi everyone, welcome back. So, in this lecture, let us compute the future pricing with some real time data. Let's say I expect the share price of Reliance Industries Limited to increase in the next 3 months. So, instead of buying the shares today, I want to lock in the price now for a future purchase. So, this is done through a futures contract. But how do we calculate the fair value of this futures contract? First, we need to know the current market price of Reliance shares. A quick Google search shows us that the spot price of Reliance share today is 2708.15. This means if I buy Reliance shares in the cash market, this is the price I will have to pay per share. However, I don't want to buy the shares right now. I want to purchase the shares approximately 3 months from now, that is on 26 December 2024, but at the price fixed today. So today's date is 16th October 2024. So we have around 71 days to expiry. So to calculate the fair value of the future contract, we use the formula spot minus D into 1 plus R to the power T. So spot S is the current spot price of the share, D is a dividend, R is the annual risk-free rate, and T is the time to expiry. So the risk-free rate helps us account for the time value of money. Typically, we use the 364-day T-bill rate, which is currently 6.55% per annum. Since the contract will expire in 71 days, the value of T will be 71 divided by 365. Next, we need to determine if Reliance will pay any dividends during the 3 months period. A quick review of Reliance's dividend history shows that the company declared a dividend of rupees 10 per share in 2024. Historically, Reliance tends to pay dividend only once a year, though the timing may vary. So, it is reasonable to assume no dividend will be paid in the next 3 months. Since we assume no dividend, D will be equal to 0. Let's now apply the formula. So future price is equal to 2708.15 minus 0 dividend into 1 plus 6.55% to the power 71 by 365. So this gives us 2741.77. The fair value of the Reliance future contract is 2741.77. This means if you lock in the price today, you will need to pay 2741.77 per share after 71 days, regardless of how the market moves during that period. By using this contract, you can protect yourself from the potential price increases while still benefiting from the certainty of a fixed price. Now, let's compare this calculated fair value with the market price of the December futures contract. To find the market price, Google search for NSE India equity derivatives historical data. Click the first link you see in the search results. On the NSE page, select the instrument type as stock futures. Choose the symbol as Reliance. Set the year to 2024. Note that the last Thursday of every month is the expiry date for stock futures contract on NSE. So select the FAR month contract, that is December 26, 2024 as the expiry date. In case the last Thursday is a holiday, the previous trading day will serve as the expiry. At any given time, there are typically three contracts available: the near month, next month, and far month. For instance, if you are in October, the October contract is a near month contract. November is a next month contract, and December is a far month contract. Now, leave the option type and strike price empty. Click custom time period and provide from and to date as 16/10/2024 and click go. Look for the settlement price of that contract. So the market price for the December contract is 2757.90. But our calculated fair value was 2741.77. This shows that the market price exceeds the fair value by 16.3 rupees. Thus, the contract is overvalued by 16.13 in the market. It's important to note that unlike forward contracts, futures contracts are standardized and traded on the exchange platform. So the exchange sets specific terms like the expiry date, lot size, trading hours, and margin requirements, which all traders must follow. So for Reliance Futures, the lot size is 250 shares, meaning you cannot transact a single unit. You must buy or sell at least 250 shares per contract. Note that companies with higher share prices typically have smaller lot size, while those with lower share price have larger lot size. So you can use the same process to check the future price of any stock or index traded in the FNO futures and options segment for specific dates. However, the NSE website only provides end of the day data, EOD data, meaning you can view the current day's future price only after the market closes, which typically is updated around 6 pm. However, you can access past historical data at any time as it has already been updated. Now, you might wonder why the future price could differ from the spot price. This brings us to two important concepts, contango and backwardation. Contango happens when the future price is higher than the spot price. It reflects the cost of carrying the assets like interest, storage, and insurance. In this case, since the December future contract is priced at 2757.90, which is higher than 2708.15, the spot price, this is an example of contango. It usually happens when investors expect the prices to rise. Backwardation is the opposite. It occurs when the future price is lower than the spot price. This can happen if there is a high demand for the assets right now, or if people expect the price to fall in the future. Think of it like a clearance sale, where current demand pushes up the spot price, but future prices are expected to decline. So, in this lecture, we have learned how to calculate the fair price of future contract using real time data, how to compare the calculated value with the market price to see if the contract is overvalued or fairly priced, the concepts of contango when future price is greater than the spot price, and backwardation when future price is less than the spot price. So, before we wrap up, here's a task. So, try finding examples of contango and backwardation in other commodities or stocks. Look at crude oil futures or gold futures. Those markets often show these kind of patterns. So, that's all for this video. I hope you now have a clear understanding of future pricing. See you in the next one. Thank you.